In the last week, the price of gold has rallied to close to 8-year highs, jumping as much as 25% in just 2 months. The uncertainty around COVID-19 has created a surge in demand for the safe haven asset, despite the fact that equities have performed surprisingly well since the crash in February. Joining me on the podcast today is Daniel Lacal, Chief Economist at Tressis, to understand where next for gold. Daniel, great to chat to you as always. Now, given the sort of dismal economic backdrop that we're suffering at the moment, it's interesting to see just how well equities have been performing. But at the same time, investors have been lapping up gold in an attempt to sort of shelter from that storm. So can you kind of help us to understand what's going on in terms of this major disconnect in markets?
Yes, I absolutely agree that there's a huge disconnect between markets and the economic reality. And it's fundamentally based on the view that 2020 is a lost year. And therefore, what investors need to think about is 2021 as a recovery year. It looks a very dangerous bet to me, because if there's anything that we have learned from this crisis is that estimates for 2021 remain excessively optimistic, and that the V-shaped recovery is more than elusive. So everything is driven by central banks, to be fairly honest. The reaction of markets has been very aggressive to the liquidity injections coming from the Federal Reserve and the European central banks. But I think that at the same time, that level of risk-taking is too high, considering the challenges, both on the economic growth recovery, but more importantly, because it's been driven by the most cyclical sectors, the recovery in earnings, cash flow, and balance sheets.
So it's been interesting when we look at the FANG stocks and how they've been performing this year compared to what we're now calling the BANG stocks. So some of those gold stocks like Barrick, Anico, Eagle, Newmont, and Goldcorp, those have actually been outperforming the FANGs. Do you think that gold stocks could continue to outperform?
Well, I think that there's two things happening in miners. One is the massive level of underweight positions that existed previously. And I think that once you see that the commodity is starting to rise, then the reaction is actually very aggressive with low volume as well, which I think is an important factor. But it is, I personally always say that if you want to look at the world of metals or commodities, and you want to invest in the fundamentals of those metals or those commodities, the best way to play it is through the commodity itself or the metal, not through equities, because cost of capital is also rising, and there are challenges of financing, etc.
Now, there appears to be a little bit of optimism in the markets this week, potentially towards a vaccine for COVID-19. That's after the drug maker Moderna said that its early stage trial had gone well, although some of the experts are less sure. Where do you stand on the likelihood of a vaccination this year or next, and what could that mean for gold?
Well, let's start from the hopes about a vaccine. If there's two things that we know about COVID viruses. One is that there has never been a vaccine for a COVID virus. Never. So that's something that we need to pay a lot of attention to when we get these levels of optimism in the market about the vaccine. Because, when 18 previous types of viruses have never seen a vaccine, you cannot expect it to happen, or at least happen as quickly as markets would want. The second is there is likely to be a treatment. There is likely to be a way to live with COVID-19. What is the outlook for gold in that environment? Well, if anything, gold has proven in 2019 that in an environment in which markets remain positive and remain attracted to a certain level of expectation of economic growth, gold and the dollar do and can rise in tandem. So I think that the fundamentals for gold are very clear. It starts with emerging market demand. Even in a recovery, emerging market currencies are under pressure. With emerging market currencies under pressure, domestic savers and domestic investors look for ways to preserve the value of their savings. Gold is a clear alternative to that. Second is central banks themselves, is that if we believe that central banks are going to continue to inject liquidity, they're also going to continue to increase their holdings of gold as they did in the past. And the third is an inflation hedge. Gold is currently working as an alternative and as a decorrelated asset to a downturn. But we must remember as well that it is a pretty good inflation hedge. So in general, I think that the outlook for gold, even in a recovery, is actually pretty good.
So where do you stand then for the outlook for inflation? Because we obviously have seen these major monetary and fiscal stimulus packages all around the world. Do you think that's going to start weighing on price levels? And you talked about the implications for gold in your previous answer, but presumably that would be bullish for gold if we do see prices start to rise again, because they have been subdued for quite a long time now.
I think that we're already seeing signals of inflationary pressures in food, very evident, in non-replicable goods. I think that those are very clear. We might have headline CPI low, and I think that the risk of even disinflation in headline CPI because of the amount of output gap that is being created from the collapse in the economy. But we must not forget that at the same time, food prices, electricity prices, healthcare, all those factors are rising. As such, I think that like we saw in 2018 and 2019, gold has to work more as a hedge to the increase in prices for non-replicable goods. That's what you need to pay attention, not headline CPI. Headline CPI is likely to continue to be subdued.
Where do you stand on sort of gold versus silver? Because we've seen an impressive rally for silver as well by more than 50% since those lows in mid-March. We did see a spike in the gold-silver ratio, but it has come down a bit now. I mean, is that something that you pay close attention to? And given the fact that silver does have industrial uses as well, do you think that's possibly a better investment or trade opportunity right now than gold itself within the precious metals complex?
I always tell my clients that if you like gold, you certainly have to like silver. I don't understand why would you be long silver, short gold, or have it in as a pair. I think that you need to have both. But I don't believe in the debate about the ratio of gold to silver. Reminds me of the debate about the ratio of oil to natural gas. And I think that was a mistake in the past when people said, well, it's 6 times oil or WTI to nat gas or whatever. And the same now. I think that silver has its own fundamentals. They're pretty good fundamentals in supply and demand. But silver is a precious metal that has numerous positive elements in order to be comfortably bullish. However, it is not money. And this is the important thing in a monetary debasement craziness like the one that we're living, is that the only asset that has been proven for centuries to be an alternative to money, the only asset that has proven to be money is gold. And I think that will maintain the ratio high. But again, I think it's a debate that is interesting, but I think that any investor that thinks that gold is attractive should have silver and should have palladium as well.
Now, for an investor or a trader who might be listening to all of this and thinking the precious metal complex is looking really interesting, the gold market in particular, I mean, given the gains that we've already seen, do you think it's too late to get into that sort of long gold trade? And if not, how much further could it run from here?
It is a monetary view, to be fairly honest. If investors believe that central banks are going to continue to inject the amount of liquidity that they have promised and more, inevitably, the price of gold will rise further relative to local currencies, for sure, and relative to the dollar. So I don't think that gold is going to be as bullish relative to the dollar because of the high shortage of US dollars that exists in the economy right now, which is about between 13 to 20 trillion. However, we need to think that the world of investment is global, and that global investors are likely to look for opportunities to find a good investment relative to their currency. Now, so Brazilian investors, Turkish investors, Chinese investors, Japanese investors, European investors are likely to see a much better return of gold relative to their currencies than relative to the US dollar.
All right, Daniel, that's all we have time for today in our podcast. Thank you to my guest, Daniel Lacalle, Chief Economist at Tressis. And thank you for listening to IG's Trading the Markets. I'm Victoria Scholar, and don't forget to subscribe to our podcast for more updates on the markets.